Very warm welcome to this evening's webinar. My name's Tim Bennett, Head of Education at Gillick & Co, and I'm delighted to be joined by my usual, or what's becoming my usual trio of speakers who'll be doing most of the legwork this evening, and that is Will Stevens, Head of Financial Planning, Shaun Robson, Head of Wealth Planning, and Sarah Hollowell, Director in charge of Trustee and Tax Services. So with no more ado, a very quick introduction as to what's going to happen. We're going to be talking about things to think about before the 5th of April, end of the tax year. Also looking slightly beyond the 5th of April to wider planning considerations to think about with some of the changes that are coming through. The idea in terms of structure will be that we will have a discussion for the first section amongst ourselves, as it were, and then there'll be plenty of time for questions and answers, aiming to wrap up after about 45 minutes or so. But if there are lots of questions, fear not, we will leave a bit of extra time to deal with them. So that's the structure, and please feel free to pop any questions that you may have into the usual box, and we'll pick them up either as we go along, if that's relevant, or pick them up towards the end. And the final thing I'll say before I hand over to Sarah in a moment is that we will be giving some further sources of information at the end and a way to get more information from Gillick & Co should you wish to do so. So with that in mind, that structure in mind, Sarah, perhaps I can turn to you first to just outline, before we go into any of the sort of tax wrappers as they're called, just outline some of the ways in which people should remember to use, basic allowances and reliefs.
Sure, thanks, Tim. Well, the topic is quite wide, so I've just picked a few of my favourites, starting with capital gains tax. So each year, every individual has an annual exemption limit, and this is the amount of gains that can be made before any capital gains tax is actually payable. And this has been gradually increasing over the years and is currently £12,300. However, after the 5th of April this year, this will be more than halved to £6,000, and then next year it will be reduced further to £3,000. So it's really important to make best use of the exemption limit now, and there are a few ways you can do it. Firstly, by selling or transferring some or all of a holding that carries a lot of capital gain, i.e. where it's worth significantly more than you paid for it. And if you don't want to lose exposure to that holding, if you want to, you can then buy it back either in your JISA or your SIP without any tax consequences, or your spouse or civil partner can buy it back in their name. If you choose to buy it back yourself outside a tax wrapper, make sure you do so more than 30 days after the date of the sale. And if you're selling a property that isn't your main home, or it hasn't been your main home throughout the whole period of ownership, and if a capital gain on the disposal is likely, try to exchange contracts on or before the 5th of April so that you can make best use of the current annual exemption. And obviously, if the property is in joint names, there could be 2 exemptions to take into consideration. And the difference between exchanging contracts before the 6th of April and after could make quite a difference. It's up to £3,528 in tax. So my second point, as well as making use of your own annual exemption limit, you might want to consider transferring assets to your spouse or civil partner so that they can make use of theirs. So transfers between spouses are done on a no gain, no loss basis. So instead of receiving the asset at the market value on the date that you transfer it to them, they're effectively treated as buying the asset at the price that you paid for it. And they can then sell enough assets to utilise their own annual exemption. And also, if one spouse pays tax at a lower rate than the other, it can be worth transferring assets to them, even if their annual exemption has been exhausted, if they're going to be paying capital gains tax at the lower rate of 10% rather than at the higher rate of 20%. The third point relating to CGT is that if you've already made a capital gain during the year that's over the annual exempt amount, consider either selling other assets to crystallise a loss, or if you own assets that have become worthless, consider making a negligible value claim. You have to be really careful when you're doing so, particularly with valueless holdings, because they can be really tricky to get rid of. So if you donate them to charity, the transfer is exempt for CGT purposes, so the loss won't be allowable, which would completely defeat the object of the exercise. And if you transfer them to a family member, the loss that's crystallised there would be known as a clogged loss. So that type of loss can only be set against similar gains. So turning to income tax, you have a bit less control here usually, but you can make sure that you know exactly what to expect to avoid potentially horrible surprises at the end of the year. So the annual personal allowance of £12,570 will remain the same in 23-24 as it is at the moment. And with inflation being as high as it is currently, freezing the allowance is effectively a reduction to the value of the tax-free amount that you have. So that's one example of what people mean when they refer to stealth taxes. But one change that's actually happening is the reduction to the threshold where additional rate tax is due. So from the 6th of April, taxable income over £125,140 will be chargeable at the additional rate of 45%. And the threshold is currently 150,000, so there's quite a reduction there. But I think that as well as that, you need to keep an eye on other thresholds, just make sure that you're aware of them. So again, to avoid nasty surprises if you unwittingly end up with a tax liability. And the first one that springs to mind is the £50,000 limit, where entitlement to child benefit reduces. So this is where one partner receives income over that threshold, even if that isn't the partner who physically receives the benefit. And I should mention here that you can have two partners each earning, say, 45,000, so total family income of 90. That doesn't result in a reduction to the benefit. Doesn't make complete sense, but it's a cheaper way for HMRC to actually deal with this. Now, a lot don't realise that the child benefit charge is collected in the same way as income tax, either via PAYE or through self-assessment. So if you or your partner has income over 50,000, and one of you has received the full amount of child benefit, you should notify HMRC as soon as possible. And the next threshold to watch out for is the £100,000 limit. This is where the personal allowance, I mentioned earlier, the one that's being frozen, it's reduced by £1 for every £2 earned over that limit. And this can result in an effective tax rate that's much higher than the 40%, which is physically deducted. So somebody who earns £60,000 a year would receive more in their pocket from receiving, say, a £10,000 bonus or a £10,000 pay increase than someone earning £100,000 would receive. So although they're in the same tax bracket, they can end up paying more tax on certain amounts of money. And these anomalies in the tax system make it really hard for someone without knowledge of the way that the rates and allowances work together. So I think that the key takeaway for the end of tax year is that if you pay tax via PAYE, either from your job or from your pension, make sure you keep an eye on these thresholds and keep a note of them, and make sure that you've seen a copy of the coding notice that HMRC have issued for you for 23-24 before the end of this tax year. These notices are either sent to you by post, or you can view them in your personal tax account if you have one. Lots of people set them up and then never look at them again, but it's really important that you look at your coding, because if you check it now, you can make sure that you've been allocated the correct allowances before the new tax year starts. Getting the code right now can reduce the likelihood of getting a large liability after the year has ended. And the last key point here, really, it doesn't affect everybody, but something to make note of before the end of the tax year is the marriage allowance. And this is where up to 10% of your personal allowance can be transferred to your spouse or civil partner to reduce their tax bill by up to £252 in the year. So to be able to do this, your income needs to be below the personal allowance and your partner needs to be a basic rate taxpayer, or the other way around. And this doesn't apply where one spouse is a higher rate or an additional rate taxpayer. And if either of you are over the age of 88, you might benefit more from married couples allowance, which is much more generous.
Excellent. Thank you, Sarah. So what we're saying is there are quite a few ways before you even get to sort of tax wrappers, potentially, of just minimising the tax that, say, a couple might be liable for, whether capital gains tax or income tax. Can see, by the way, that a couple of questions have already come in. Stuart and Tony, thank you very much for those. We will pick those up towards the end, if that's okay, because what I'm going to just do now is hand over to Will, just to bring us into some of the most common ways to save tax within some of the sort of common tax wrapper structures. And I think, Will, you were planning to start on fairly friendly turf with JISA.
Yeah, absolutely. Thank you, Tim. So I think I'll start just by explaining, you've used the phrase tax wrapper there, so I'll just quickly cover off what that means for everyone. So a tax wrapper is simply a type of investment account that you can own, that when you hold investments within it, there's a specific tax benefit to doing so. And I'm going to start with the, I guess, the simplest one, which is the JISA. So many people will be familiar with ISAs. You can get them in the form of cash ISAs. Banks tend to offer them with interest rates, or you can get stocks and shares ISAs, like the ones that Killick offer, in which you can invest into the stock market through funds or in direct equities. The importance of tax wrappers is sort of growing with these changes that are coming from this year and into next year. As Sarah mentioned earlier, the CGT allowance is coming down, and it's getting pretty much halved this year and again next year. Alongside that, the dividend allowance, the amount of dividends you can receive from your investments before you have to pay tax, is also coming down at the same time. It's going to be halved this year and halved again next year. So when you take these into account, they're going to create what's a sort of drag on your investments and the return that you get and the money that you actually have at the end of the day to live off. So you can use things like an ISA to hold your investments, and that tax wrapper that sits around the investments, the ISA account in this example, protects the investments held within them from any future tax on either capital gains or income arising from those investments. The thing that makes the sort of ISA so efficient is that you put money in, £1 in is £1 in, and when you take money out, £1 out is £1 out. There is no tax to pay on it. So it really is protecting it. There's an annual limit on these ISAs, as there's always going to be. It's £20,000 a year as it stands currently. That's per person per year. So if you're in a couple, you've got £20,000 a piece to play with. So going back to Sarah's point about making sure that you utilise both spouses' allowances, that carries across to tax wrappers as well. Beyond ISAs, there are sort of other other specific areas within the ISA world to talk about. One of these is, I guess it sort of tends to have fallen out of favour in the market at the moment, which is the lifetime ISA. The lifetime ISA is a slightly more complicated version of an ISA. There are certain rules around it. For every sort of pounds you put in, you get an element of tax relief or sort of additional credit from the government. So you can put up to £4,000 a year into a lifetime ISA, and the government will give you up to another £1,000 on top of that. So you get a sort of 25% credit, if you will, from the government for the money you put in. Now that £4,000, that does eat into your overall ISA allowance for a year of £20,000. But it does mean that you could potentially get another £1,000 back from the government. The lifetime ISA, though, has two key restrictions on it, which are what the money can be used for and who can put money into them. So a lifetime ISA can only be opened up until the age of 40, and you can only contribute to them until the age of 50. And the money that is in a lifetime ISA has to be used for one of two things. It can either be used to purchase a property, your first home, and there are restrictions on the value of that property. For example, in London, it's £450,000 currently. Or it can be used over the age of 60, you can draw from that fund as well. If you use it for anything else, you will pay a penalty equivalent to the tax credit you were given by the government at the time for drawing the funds out from the LISA. So whilst they may not necessarily be the most popular vehicle of choice, I think as part of a long-term, potentially retirement planning strategy, that can form a key part of that. The final one I just want to touch on is, junior ISAs, or ISAs for children, which is again something that people tend not to think about so much, but is an incredibly powerful tool. The junior ISA allowance is £9,000 a year as it stands currently. And if you were to sort of put £9,000 in a year, compounding at 5% from the year of birth to the age of 18, at the age of 18, that fund could be worth as much as £260,000. And those numbers sort of only get bigger the longer you leave it. So putting that money away early really does make a key difference. That £260,000 could end up paying for university fees, a first car, and possibly also a house deposit on top of that. And I think really the one thing I would focus on in terms of the time horizon, i.e. we've got the end of the tax year just down the road, and then we'll be into a new tax year, is making the most of these allowances if you haven't already. If you have surplus cash or capital looking to invest, these would be the sort of first stop, port of call for getting that money invested in a tax efficient manner. You get one allowance till the 5th of April, and then on the 6th of April, you're going to get another one. So if you've got cash available, you could get 2 lots of ISA allowance in the next couple of months invested. But also to make use of them now whilst they're at the size they are. You know, a lot of pressure is now being put on tax allowances and sort of bringing those down. Shaun will talk more about the pension allowances in a minute. And so we want to make sure that we're making use of those while they are the size they are, because they are considered relatively generous. They have jumped up quite a lot over the last decade.
Excellent, thanks, Will. And I guess those 3 things you talked about there, the only one that's truly fully flexible is the ISA, arguably. The others, the lifetime ISA, the junior ISA, come with certain restrictions in terms of how the money is used or when it can be used. And I suppose that brings me to Shaun to talk about, you know, one of the bigger tax wrappers out there, but again with a few caveats, if you like. Don't get something for nothing from the government. Shaun, perhaps you can talk about where you see pensions and SIPs in particular.
Yep, great, thank you, Tim. As a starting point, I think it's clear to say pensions are a great way of building up money to live on in retirement. This is looking at much longer term tax wrappers. And there's many advantages to using pensions and SIPs, as you mentioned, Tim, that can make your investments grow quicker due to the tax benefits attached to them. Now, pensions have been subject to many changes over the years, which only adds to their complexity. But I think one thing is clear is that governments have been keen to promote individuals saving for their own futures, which is why when you invest into a pension, you get tax relief on your contribution, meaning some of the money that you would have paid to the government in income tax goes into your pension instead. So a really great benefit as a starting point. Now, there are strict limits on the amount you can contribute into a pension and get tax relief. This is known as the annual allowance. Now, the maximum has varied over the years, and it depends on a number of factors. That's included, but not limited to, things like your total income in the tax year that you're going to make the pension contribution, your age, if you've ever taken money out of a pension in the past. Now, broadly speaking, those who are, working individuals with income of less than 200,000 a year, you can contribute up to 40,000 a year and benefit from tax relief going into your pension. As an example, if you're a basic rate taxpayer and you contribute 40,000 to your pension, the true cost to you is actually only £32,000 because you will get tax relief of £8,000 on that contribution straight away. For higher rate taxpayers, the benefit increases even further. So the tax relief you will receive as a higher rate taxpayer paying 40% tax is £16,000 on a £40,000 contribution. So the cost to you again reduces to £24,000. It gets a little bit more complicated for those earning over £200,000 a year. The annual allowance calculation is effectively on a sliding scale. It's something that the government introduced back in 2016 and is known as the tapered annual allowance. Now, this could restrict pension contributions for those that have higher incomes when you get to a point of earning over 312,000 to a maximum of £4,000 a year. So for anyone that's in that element of higher earnings, they need to be really careful with the calculation to their pension contribution, because if you over contribute to your pension, then there will likely be what we call an annual allowance tax charge, which effectively negates the tax relief that you were trying to benefit from in the first place. Now, the reason we're highlighting pensions at the tax year end is because if you don't use your allowance, you can lose it. Now, unlike ISAs, as well as I highlighted, where you will lose the allowance immediately if you don't use it by the 5th of April. Now, pensions have the benefit of allowing you to look back over the last 3 tax years and use up any unused allowance that may still be available from those previous tax years. Now, that's quite a unique benefit of pensions and gives those individuals that have not funded pensions for some time perhaps a second chance to make use of those allowances. Now, if you have money that you can commit to your longer term retirement planning and you don't need to access it beforehand, pensions are a great way of saving and building your investments for retirement.
Fantastic. So thanks for that. And we've got, as I say, some great questions coming through. We'll probably deal with those in the last section, but perhaps before we get to that, can I just widen it out now and just say, having dealt with some specific reliefs and allowances, some specific tax shelters, thanks for that, Will and Shaun. Perhaps I can go back to you, Sarah, just for a sort of a step back and some of the broader planning considerations that you quite regularly come across and deal with.
Okay, sure. I mean, you might be at a stage of your life when you're considering reducing the value of your estate for inheritance tax purposes. So far, we've only looked at income tax and capital gains tax. And again, the nil rate band has been frozen while property values have continued to increase, which has led to estates having a higher value and so more is accessible to inheritance tax. So again, freezing allowances is seen as a stealth tax, as we mentioned before. So if you're looking to reduce the value of your estate, and if you can afford to do so, then one thing that you can do each tax year is make sure that you make full use of the annual gifts allowance. And it does soon mount up. So the amount that you can give away each year is £3,000. And that's whether it's made up of money or assets. So you don't have to give away cash, you could give away shares, you can give away anything. And you can give this to either one person or split that £3,000 between more than one person. And the benefit here is that if you didn't make any gifts in the previous tax year, you can carry the exemption forward to make gifts of £6,000 in total, but you can only carry forward for 1 year. And then as well as that, you can make special gifts when someone gets married, and you can make small gifts of up to £250 to as many people as you like, as long as none of those people have received your £3,000 or part of the £3,000. And there are other ways to reduce the value of your estate, such as making potentially exempt transfers, which are gifts that are larger than £3,000, or regular gifts out of income, but these would generally be seen as part of a wider tax planning strategy rather than end of tax year planning. And if you are considering a more complex tax planning strategy, there are other options that you could think about, and I think Shaun and Will are going to tell you about a couple more of those.
Yeah, perfect. Thank you, Sarah. And just before I jump on to looking at some of those options, one thing I did want to touch on was linking, where Sarah's talking about gifting to the next generation, is Will touched on the use of perhaps junior ISAs, lifetime ISAs. One element to also consider is junior pensions or junior SIPs. I've talked a little bit about the ability of those who are working to make pension contributions and benefit from valuable tax relief as they're building their pension funds. But pensions can also be a really valuable tool to save for the next generation. Now, Will talked about junior ISAs and lifetime ISAs, but even those under 18 can benefit from saving for retirement via a pension. Now, it may be many years away, but the compound effect of making pension contributions now for a child can be huge. And Sarah's talked about potentially the ways that you can make those gifts to the next generation tax efficiently. If we look at tax relief not being limited to just those who are earning, it's also available on a smaller scale for all, including those who don't earn, including children. The maximum contribution is limited to £3,600 a year, which includes tax relief of £720. So the cost to you net would be £2,880. And as an example, if you were able to save the full annual allowance each year for a child, so £3,600 a year for the first 18 years of a child's life, invest those funds and benefit from a return of 5% a year. At the age of 18, that pension pot would be worth around £105,000. If no further contributions were made beyond the age 18, and we roll the clock forward another 40 years, and that child is now heading into retirement, if the pension fund had remained invested throughout that entire period, again benefiting from that compound 5% growth a year on the investment return, that pension pot could be worth somewhere in a region of £770,000. So a really significant pension pot that's built from contributions that are made throughout a child's lifetime through to age 18. Now, I think some people may see pension savings as quite restrictive, blocking you in as you can't access those funds until retirement. But I think another way to look at them is the protection that they can provide. The fact that they can't be touched until retirement means that they can't be used as a cash flow machine, perhaps in earlier years. This can provide protection when passing money to the next generation. And when they're used in conjunction with the wrappers that Will has talked about, junior ISAs, lifetime ISAs, etc., you can build a good blend of tax efficient funds available at different points in that child's lifetime, and as they head into adulthood, as they look to perhaps get on the property ladder, and also helping them start to build the savings mentality of putting money away for the future. Now, If I move on to looking at the benefit of building your savings and investments in the way that we have discussed today, by making use of all the allowances, the exemptions, the reliefs that we've talked about, clearly you can see the immediate benefits that will compound throughout your lifetime, but you will really benefit when you come to retire, as you will have the ability to create an income stream from all these various sources that we've talked about in a really tax efficient way, whether that's across your ISAs, your pensions, your general investments accounts. And as an example, the government provides us with tax-free allowances each year, which if used effectively can provide an individual with a tax-free income and capital of around £27,500 individually, or £55,000 as a couple, by using the exemptions that Sarah has talked about in detail. And if we look beyond the basics that we've explored here in a bit more detail, there are further tax efficient investments and structures that can also be considered. As complexity increases, costs also tend to increase, so they are only relevant in specific circumstances. But as an example, perhaps those with larger capital sums, perhaps where they may have exited a business where there are funds currently invested and they're subject to ongoing taxation. Tax wrappers like offshore bonds can be really beneficial. Investments like venture capital trusts and enterprise investment schemes that offer tax deductions can also add a further dimension of tax efficiency as you look to start to build that retirement income stream for the income that you need in retirement. So you can quickly see that a combination of all these solutions puts you in the strongest position to minimize taxation, maximize your returns on investments, and benefit more from the risks you are taking.
I think just to add to what Shaun's saying there, I think I'll give a bit of clarity through perhaps a client example of a case I've been working on recently for a couple, to give a bit of flavour to everyone. So, I've been working with a couple recently where the husband works as a city professional. He's earning sort of £450,000 a year. The spouse doesn't work. She stays home and she takes care of the children. They've got 3 young children. And as a result, they're looking to save and invest for their future, but also their children's future. They're thinking about the fact that they've got school fees, some in payment now, others to come in the future. But they also want to make sure that they can stop working at the point that they want to. Now, as Shaun's touched on the limits and allowances for pensions earlier, he can only put £4,000 a year into his pension. His wife can only put £3,600 into her pension because she's a non-earner and he's fully tapered. They're putting £20,000 a year each into their ISAs, but they still have some surplus that they still want to save and invest for their future so that they can use it when they need it. And that's where we've started to look at various other options. So any investments that are held in a taxable account, they've got some old shares from jobs, for example, and other things. We've moved those into the wife's name because she's got a lower level of income and therefore paying less tax on the resulting income from those investments. And then we've also started to look at these enterprise investment schemes and venture capital trusts, EIS and VCT that Shaun just mentioned. Now, those investments are sort of buyer be warned, they are higher risk than other investments. They tend to be fairly early stage companies. However, the government does want to support individuals to invest into those. And so those can come along with quite nice tax incentives, what's known as tax incentivized investing, where the government will give you potentially 30% income tax relief on the money you invest. But there's another caveat to that, which is you are going to have to hold that investment for a minimum period of time, either 3 or 5 years, depending on what you've gone into. So there's higher risk, potentially some good rewards there on the income tax side, but there are going to be holding periods. But you can see as you start to stitch those elements together for our clients, we create these blended strategies, which then deliver hopefully what they're going to need, which is some liquidity in the form of ISA investments and some tax efficiency and retirement savings on the pension side.
Fantastic. Well, thanks very much, Will, and Shaun and Sarah as well. That, I think, leads us neatly into the Q&A section. Lots of questions have come in. Do feel free to add them into the usual place. We'll try and deal with as many as we can, and I may break off midway through the questions just to give Kat an opportunity to put a slide up, which will tell you where you can get more information. So let's start with Tony, and I'll throw this open, and then there's a couple directed at specific speakers in a moment. I'm retired and therefore have no income. So I think the maximum I can invest in my pension is 2,880. Can I backdate this at all? As I've invested in my pension for many years. Who'd like to take that one on?
I'll take that one if you like. I think what Tony's suggesting is sort of what Shaun was talking about, which is that carry forward allowance from past years. Now, the way the carry forward allowance works is it allows you to put pension contributions in this year that were unused from previous years, knowing that the annual allowance is sort of £40,000 per person. The caveat to that is, in order to make a pension contribution in the current year, you need to have the right level of relevant earnings to make that contribution. So your pension allowance personally for you is not only up to the £40,000, but capped at what your level of relevant earnings is. Relevant earnings being income from employment or self-employment, not including dividends or savings, etc. So in answer to Tony's question, unfortunately not. As a non-earner, you are going to be, if you're a non-earner and you don't have any income from employment or self-employment, then you are going to be capped at that 2,880. You'll get the nice 720 tax relief to take you up to 3,600, but you won't be able to utilise any carry forward from previous years.
Excellent, thanks, Will. So moving straight on to Stuart. Thanks, Stuart, for the question. Maybe one for Sarah, I don't know, but if selling a fund and buying it back 30 days later, can that time be reduced by buying a different fund, so something which is not identical to the original one? So hinting there at the sale and buyback rules to perhaps lock in a capital gains allowance for the future. Sarah, do you want to take that one on?
Yeah, sure. That's absolutely no problem at all. If you're selling one fund and buying back another fund, then you can do them pretty much at the same time. You don't have to wait 30 days.
Tim, you're just on mute, I'm afraid.
There we go, talking to myself as usual. Thanks for that heads up, Will. Questions get less interesting if you can't hear them. What is the tax payable and any interest earnings gained from fixed rate savings? Do they also fall under capital gains? So this may be, I guess, a bonds question, but anyone like to take that one on?
Sounds like income. So if you invest an amount in any sort of account, that's your capital. And then the money that capital produces will be income. The capital gain is if you've got an asset that increases in value, the actual asset increases in value. So it sounds as though this is a question about income tax. So it's interest, and that would be taxed at income tax rates rather than capital gains tax rates.
Fantastic. I feel like this is one of the rounds on Mastermind, if you like. The rate these are coming in, it's brilliant to see all these questions. So Shaun, your moment will come. This might be one for Will. I don't know. Are bear trusts or junior ISAs better for grandparents to put money in for grandchildren?
That's a very difficult one to answer without knowing what the fund may be for. To give a really quick example, if you were utilising the benefits of one or another, if you're looking to give them money for themselves to spend in the future as an adult, I would probably lean towards considering a junior ISA because it's going to wrap it in a tax efficient environment. However, if that money is potentially for their education before they turn 18, or there might be a need for it before they turn 18, we'd consider the bear trust. But as with all those things, I would probably recommend seeking advice on that, if I'm being honest, and discussing that with an advisor. Okay, fantastic. A more clear-cut one, I think. Junior ISA allowance of £9,000 per year, which Rishi Sunak increased relatively recently. Is that on top of the £20,000 allowance for stocks and shares? I.e., does that create 29 in total per person, sort of thing? This is actually a point that I was going to cover, and then I forgot to earlier. So thank you for the question.
Good prompt.
It's great prompt. So there is the junior ISAs for anyone up to the age of 16. They can contribute £9,000 a year. So you can put up to £9,000 a year into your child's junior ISA. You've got your own ISA allowance of £20,000 a year. There is a slightly complicated bit where technically your child can qualify for an adult cash ISA at the age of 16, and a junior ISA that they're still running. So there is a period of time when they're sort of 16 and 17 before they become 18, when their junior ISA turns into a full adult ISA. There's a point between at 16 and 17 where you can, in fact, do a junior ISA contribution into a stocks and shares ISA and an adult cash ISA with a bank for £20,000, and they can get £29,000 into an ISA in those years.
Fantastic. Shaun, possibly one for you here. I'm just going to jump down the list. Is there an age restriction or limit on contributions to a pension? That's from Ronald.
So there is no, as a starting point, you can, as I mentioned in the original conversation, you can start saving from a pension from day one. As soon as a child is born, they're entitled to have a pension opened on their behalf, and anybody can contribute into that pension. And you can continue to save and benefit from tax relief throughout your entire life, all up to age 75. Now, there are certain restrictions along the way, depending on your income throughout the lifetime. If you then start to take benefits from a pension, your tax relief on contributions can be restricted. It's what we call the money purchase annual allowance. But very broad brush to answer the question, you can continue contributing all the way up to age 75 and benefit from tax relief of some sort on the way through. Now, that amount may vary each year, but principally, yes.
Great, thanks for that, Shaun. By the way, Kat, if you're out there, I just wonder whether it's worth popping up the slide that gives people the opportunity to potentially ask for more information, and then we can carry on with the Q&A. So for those people watching live at the moment, there should be hopefully a slide up which gives you the option to just say, yes, I'd like further contact, or no, thank you very much. And I'll just give you a moment to have a look at that. And then what we'll do is we'll jump back to the Q&A. Sarah, perhaps you would be happy to take one on there. For how long can one offset capital losses against future gains? That's from Ian.
Okay, you can keep hold of your capital losses to set against future gains indefinitely, but what you really must do is make sure that you claim them in the first place. So if you've made some losses and you haven't told HMRC about them, you really need to. You have 4 years to do so, unless those losses were made before April 96, and you can claim those ancient losses at any point. But once they're claimed, you can keep hold of them indefinitely.
Great, and I don't want to direct this in particular. It might be one for Shaun, something you mentioned earlier. I think it's a pensions question. If I didn't use the previous year's allowances and I'm restricted due to tapering to £4,000, can I still use up previous year's unused allowances this year?
Great question. And the very simple answer is you absolutely can. Now, you need to go back through those last 3 tax years and make sure that the impact of tapering doesn't affect you in each of those tax years as well, because that may limit the amount you can carry forward. But principally, the answer to the question is yes, you can still look back over the last 3 tax years and look to make up any unused allowance.
Great. Will, this is directed straight to you from Tim, not me, Tim, who's out there somewhere. So on junior ISAs, the question there is, at what age does the junior ISA become the property of the child? Now, there's sort of a nuanced answer there, isn't there? In terms of control versus full ownership. I wonder if you could just touch on that.
Yeah, so technically it's always owned by the child. It is in fact their asset. However, there's the control elements, as you mentioned, Tim, which is that from the moment they turn 18 and become an adult legally, that money is theirs and they can do with it as they will. So this is potentially a drawback to those who might be considering maximising a child's JISA every year from birth. It's certainly something to bear in mind and to discuss and to think about as part of a long-term plan. So, but no, it will legally become theirs from the age of 18.
Fantastic. Great, loads of questions coming in, so do stick around. I won't cut the session off too early. We've still got a good 5 or 6 minutes to go until 5:45. So can you pay into a SIPP, Shaun, and get tax relief whilst receiving the state pension?
Yeah, great question. So as long as you're under age 75 and you aren't drawing benefits from any other personal pensions, and it's purely state pension that you're receiving, you can still contribute as long as you've got earned income to support it, or if you don't have any earned income, you can make the non-earner contribution we talked about, the 3,600. So there is still the ability to make contributions when you are drawing the state pension.
Great. Now, this is another cracking question, Michael. Can you briefly explain, always a challenge, the pension recycling rules? Now, this is the idea, I guess, of just almost washing machine contributions to almost, in the old days, you could almost sort of get relief twice, is I suppose the way to put it. Would anyone like to just take that on? Where are we on pension recycling?
I'm happy to step in on that one. So the pension recycling rules, for those who aren't aware, are designed to stop people from taking money out of a pension where they've had tax relief and recycling that money straight back into a pension to get more tax relief. There are various built-in measures in the system now that would make that more difficult, but the one that is probably still most possible is if someone took their tax-free cash out of a pension and then used it to make a pension contribution in the same tax year. They'd need to have the relevant earnings. You'd be looking at things like potentially carry forward allowances, etc. Tapers might come into effect. There's all sorts of nuances to that, but there is a system designed in place to stop people from effectively doing that. But there's also quite a few measures in the way there that might make that quite a difficult process to go through for any individual these days, if I'm being honest. So definitely something to avoid. And if you're looking at trying to get that sort of tax relief, it's probably better to look at other options and have a conversation with an advisor.
Great, and this is probably another one for you, Will, from RAF. Is it just lifetime ISAs that are subject to the 4,000 limit? All other adult ISAs are 20,000 per year. I think you mentioned that. Perhaps you can just clarify how those two interact.
Yeah, absolutely. So an adult individual has a £20,000 ISA allowance, and they can contribute that to split that across a LISA, a cash ISA, and a stocks and shares ISA. You can only contribute to one cash ISA and one stocks and shares ISA in a year, but your £20,000 would be divisible between those three accounts. So if you use the £4,000 for the LISA, that would use £4,000 of your £20,000 allowance, and you'd only have £16,000 left to put into a stocks and shares ISA, for example.
Fantastic. Sarah, put you under pressure. Do you have to document any cash gifts you give to someone as proof for HMRC purposes? Is that a good idea?
Not at the time you make them. When you die, IHT forms have to be completed, and part of the inheritance tax form, there are questions on gifts that you've made during your lifetime, and that can make it really difficult for people if they haven't kept good records during their lifetime. So I would always recommend that you, every time you make a cash gift, keep details of that perhaps with your will or somewhere safe, or pass details of it to your tax advisor or whoever looks after your tax affairs.
Just to add to that, Tim, when I'm sat with my clients and we're talking about estate planning and looking at gifting for future generations, I always recommend to them there's a form Sarah will be very familiar with, which is the IHT 403 form, which anyone can go and search and download. And it's the form that's used for the return on death. But actually, I encourage clients to just, if they're making gifts, just to make a note of them on that form, keep it with their paperwork, as Sarah said, with their wills. And then it's very straightforward for the executors of the estate to find and reference evidence of those gifts that have been made throughout the course of those individuals' lifetimes. It's a very straightforward way of recording it.
Great. Well, Shaun, since you've grabbed the mic, there is a question directly for you from Gabrielle. Apologies for mispronunciation. Can the annual 3,600 that can be put aside for a child's benefit be put aside for someone who's not biologically related to the donor, presumably, and older than 18?
Okay, great question. So this is in relation to pension funding for perhaps someone that's not your own child. So absolutely, you can set up a pension, and so the individual can set up a pension, and any third party can make a contribution on their behalf. That contribution is treated as if it belongs to the member of the pension, so they get the tax relief on the contribution, not you making the contribution. But you can make pension contributions on behalf of other people.
I'll just jump in there and add one point, which is that if you do intend to do that, I would advise discussing it with the individual in the first instance, just to make sure that you don't breach any annual allowance rules for that individual as a result of contributing, if they themselves might be contributing elsewhere as well. So just have it as part of a joined up conversation with them.
Fantastic. So we've almost run out of formal time. I'm gonna run a few more questions and then we'll do our best to answer any others perhaps outside of this forum. It's fantastic to see so many questions. So anyone like to take on the question from Charles here? Does the contribution to a junior ISA come out of the overall 20,000 ISA allowance? I think we answered that no, essentially. Second question, what is the amount of the marriage gift allowance? Is that one for Sarah?
That depends who the gift is to. So if it's to your own child, you can give them £5,000 or up to £5,000. If it's to a grandchild or a great-grandchild, you can give them £2,500 and £1,000 to anyone else. Now that is in addition to the £3,000. So if your own child was getting married, you could, for example, give them £5,000 plus the usual £3,000 annual gift, making a total of £8,000.
Fantastic. Will, did you want to add something there, or you? No, not happy with that one. Can I start a lifetime ISA for my grandchildren, taking up £4,000 and then put the balance into a junior ISA? So I guess that's someone thinking about which is the best potential option for grandchildren. I suppose it depends on what you're trying to achieve.
Depends on what you're trying to achieve. Yeah, definitely. I have a horrible feeling, and Shaun might want to correct me on this, that licenses are not available to anyone under the age of 18. I think it would be 18 to 40 in order to have a LISA. So unfortunately, in that instance, it would depend on how old your grandchild is. But assuming that you're talking about a JISA allowance, therefore you're talking about a minor, the answer would be no, because they unfortunately wouldn't qualify for a LISA until they actually turned 18, at which point it would eat into their overall ISA allowance at that stage.
Great, we've got time for just a few more, I think. Earned income, sorry, let me just grab the question there. Earned income for pension contribution limits, does that include dividend income? So in terms of what, anyone likes to take that one?
I'll jump in on that. No, dividend income unfortunately wouldn't be included. The phrase earned income really does capture that which comes from employment or self-employment, so it wouldn't include dividends or interest paid, or even returns of capital if you've had a loan, for example.
Okay, great. Maybe one for Sarah, this one. If pension contributions are made for another person, does this equate to a gift which would need to be recorded for inheritance tax purposes?
Yeah, anything that you make to another person is a gift.
That was succinct.
So that was really quick, wasn't it? I know.
Thank you very much, Sarah. Now, I'm conscious we're 5 minutes over at this point. Thank you for all the fantastic questions that have come in. I think what I'll probably do is close the floor at this point and say that we will endeavour to answer the other questions received. All it remains for me to do is to say, for those people who want extra information on the basics, there is a how-to guide authored by me with help from the panel here. It's all about how to save tax efficiently. Events at killick.com would be a good way to get hold of that. My Killick Explains videos for anyone who wants the real basics, the nuts and bolts, are also out there on YouTube as a recent series on tax saving basics. But that aside, thanks ever so much for attending. Great turnout tonight. Thanks for so many questions. Thank you to my panel, Sarah, Will and Shaun. And I'll just wish you all a very pleasant evening.